Good evening and welcome to Bond Squad After Hours for September 30th, 2015, Part 2. I'm your host, Tom Byrne. We're doing this broadcast because the microphone once again was not working on the initial broadcast. I think I have it fixed now. Hopefully you can hear my voice. The monitor is showing that my voice is working, so we shall try this a second time. First, our disclaimer. Investment advice offered through private advisor group or registered investment advisor. Wealth Strategies Management / Bond Squad and PAG are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performances referenced is historical and is no guarantee of future results. And I will tell that to the model portfolio guys who stick to mean reversion strategies, which are in essence past performance would be indication of future results. Good luck with that, because then it really works. Well, we're going to try this once again, and maybe I'll be briefer this time around. Let's start with the discussion of the markets. We saw the markets up, or the equity markets, the Dow Jones up over 235 points today. The bulls were out of the woodwork saying, this is an indication that things are better. The market has probably bottomed. Pay no attention to the 300-point loss we had 2 days ago. It seems like every time we have a 300-point loss, it's not indicative of what's really happening. But when we have a 200 basis point increase, 2/3 of the loss, we're told that this is real. Good luck. Neither one of them is necessarily real, and both are necessarily real. It depends what happens next, right? So why am I so sure that this was not the rise in today's equity market was an indication that the economy is doing any better, or the markets are bottoming, or any other positive event? Well, all we have to do, first we have to do is look at the bond market, and we see that the yield as of the close of the 10-year Treasury was sitting at 2.037%, up 4/30 seconds in price, down in yield. Now, so we didn't have the rotation that the equity geeks think we should have when we come from out of bonds into stocks. I'm not a big believer in that in the modern world, but what's funny is that they will mention that right off the bat. They'll mention it right off the bat when it goes their way, but when it doesn't happen, well, it doesn't matter anymore. So we didn't see a rotation. We shouldn't see a rotation. It's apples and oranges. You know, it really is. One does not indicate the other. There's more forces out there than retail, moving assets back and forth in some sort of modern portfolio theory, trading strategy. The treasuries are very much an institutional world. So what in the data was different today? Well, not too much on the positive side. We had, if I get this to work, we had ADP jobs data indicate that the private sector added 200,000 jobs in September. This was up from 186, revised 186, down from 180 in August, and above the street consensus of 190. But what was somewhat, I don't want to say concerning, but of notice to me, was that 106,000 new jobs were among large companies, while the pace of job growth among small companies were cut in half from about 80 to about 39, I think it was. And we saw a drop off in the pace, not in hiring, but in the pace of hiring among mid-sized companies. All right, so this had holiday hiring written all over it to me. Large companies bolstering staffing for the holidays, shipping companies, retailers, whatever it might be. They're starting early. They have started early the past several years, and that's what that is. So if we have 200,000 jobs with large companies adding workers for the coming holiday season, you know, maybe that this 200 really isn't 200. I'll argue that 200 really isn't 200 anyway, because we have a lot of these jobs are part-time. All right, that means it might be one person getting more than one job, right? I'm gonna get a part-time and a full-time to make ends meet, or two part-times. So 200,000 jobs, maybe 150,000 unique workers. We don't know, but if you look at the wage growth that we see, or the lack of it, you know, it stands to reason that some of that is going on a real basis. And I published this in today's Making Sense report. On a real basis, we are at income levels, household income levels that we were in 1996. And that's real, so it's adjusted for inflation. So the more optimistic person can say, yeah, but look, that's based on inflation. We still have more dollars. Yeah, but inflation's only average around 2% in that time, just over. So in reality, you didn't really gain that much in raw dollars, right? And you gained nothing in real dollars, and you're way down in both from the 1999 to 2007 period. So even when you have wage growth, you're coming off a lower base. Where people were making 75, 80,000 during the last expansion, or even the last two expansions, they're making 40 to 50,000, maybe using two jobs to do it. All right. So even if you get a 2 or 3% raise in wages, you're still nowhere near what people were making a decade ago, in real or nominal terms. And I have a chart on today's Making Sense report. If you want a copy, if you're not a paid subscriber and you want a copy of that chart, I'll give you a copy of the chart. I don't make this up. All right. So we don't see these robust economic numbers. And it appears, if you look at the regional Fed manufacturing reports and even business condition reports, the headwinds from overseas are blowing against U.S. economic growth. Might not be strong enough to push us to recession. Could keep us in the 2% area, though. And I was hoping to see in today's today's ISM and Chicago Purchasing Manager data, some signs that maybe the economy was breaking out, or at least more resilient than the regional Fed numbers indicated. But we didn't get that today. ISM Milwaukee, printed at 39.44, prints below 50 indicate contraction. All right, this is down from a already contractionary number of 47.67 last month, and the street consensus of 48.5. So the numbers are already contracting, and the street already continued to believe that they would contract. Chicago Purchasing Manager, and it should be noted that Chicago data include the Detroit automakers. All right. Chicago Purchasing Manager data came in at 48.7. It contracted. I think it was the first time it contracted since June. It grew at 54.4 last month. It was expected to print at 53 even, a positive number. Remember, prints above 50 are expansion, prints below 50 are contraction. So we're seeing headwinds in the U.S. economy. It doesn't mean that we're going to recession, but we're not breaking out to a higher level. So why the rally in equities today? Well, it's the end of quarter, right? You got to window dress your portfolios if you're a money manager. So this is window dressing, in my opinion. I see no other reason. We always think that the upward move is the real reason, and when it goes down, why did it go down for? There's no reason. There's a reason for both. All right, this is probably just window dressing where we are now. So that's where we stand. So when we look at inflation, PCE reported last week was 1.3% up from 1.2. You have Europe, which just sank back into deflation, negative 0.1 headline, and not that positive core. When you back out falling commodities prices, including food and energy, you were at 0.9. It did not break higher. There is not a whole lot of inflation, at least the kind of economists look at, in the economy these days, in the global economy. And that's going to drive long-term rates one way or the other. All right. This is why we have a 203, 204 10-year, even with foreign central banks selling holdings to get dollars so they can sell dollars and buy their home currency to defend their currencies. So this is what's happening here. All right. And the credit markets are telling us there's distress. There was a big deal this week about small cap stocks selling off, and the media wanted to blame Hillary Clinton. Excuse me. I had to get a drink for that one. Blame Hillary Clinton idea that drug costs should be limited, right? Well, all right, for one thing, it's election time, right? It's campaigning season. Obviously, a Democratic candidate's probably going to take a populist stance and say, we want to limit the cost of drugs to those who need it. All right, we can argue that back and forth philosophically, but let's be honest, who didn't understand that? Is the market so crazy, so algorithm driven that when she says that it goes down, that might be part of the initial response, but small caps have not performed well for a long time now. And investors were told by professionals and by global investment committees that you must go ahead and buy small caps because they're mostly domestically focused and will be resistant to economic problems overseas, except for a couple things. These companies often provide products or services to the larger multinational companies. They also count among their customers people who work for the larger multinational companies. So if they're not doing well, it creates some sort of headwind for the smaller guys, right? Also, small cap companies tend to be junk rated companies. So if you have a crack in the junk market, which we have a big one, right, the financing conditions deteriorate, and that weighs on their stocks. And if you look at how spreads have blown out, have widened out, particularly among junk rated credits, particularly among the bottom of junk rated credits, it goes a long way to explain what is happening in small caps. Back in the first half of the year, I think it was even in my mid-year review, I advised, that I'm not big on small caps. I'd rather be mid or SMID, where suitable. And if I'm playing small, I want value. I don't want elevated PEs. I want low leverage on the balance sheet. Now they're getting thrown out with the bathwater too. Those babies are out the window as well. But at some point, those are the ones that should come back, because at some point, calmer heads prevail, and they start looking, all right, what really should be done, what shouldn't be done. We're probably seeing that in the energy sector. We have the midstream pipeline companies getting bashed along with the drillers. All right, tell me what sense that makes. It makes no sense. All right, but we live in this sleeved world, and it's told get out of energy, so they get out of energy. They don't discern what type of energy do I own. What are these companies exposed to? So now you see the proverbial babies get thrown out with the bathwater. All right, so that's what's happening, I think. So we have, we have to look at what we own and know what we own and understand what's happening. And the bond market is telling us. The bond market is telling us what is happening. If we only take the time to look. Yesterday I went to a municipal bond conference hosted by the Global Interdependence Center, of which I'm a member, and it was sponsored by Strategas. And we discussed the municipal bond markets, and we also discussed the overall economy. So I took copious notes, and there's some highlights I'd like to discuss. First, we had Mary Francoeur from Assured Guarantee, the preeminent municipal bond insurer, and she notes that before the crisis, 70% of municipal bonds were insured. Today, it's 7%, up from a low of 3% post-crisis. And also noted that spreads are so tight, yields are so low that insurance is not economical in many cases. Right. So that's how the market's changed. So remember, we all told to wait to a reversion to the mean. Well, that means very different. But as Sean Carney explained from BlackRock, that's correct, from BlackRock, he pointed out that it's non-traditional buyers that are flooding money into the municipal market. And these are foreign investors, pension funds, central banks, other institutional entities who are looking to pick up yield, not necessarily over corporates, but over treasuries. They're using this treasury alternatives. I mean, when you have the German 10-year at 60 basis points, the Japanese 10-year at 35 basis points, and the U.S. at a lofty, let's call it 204, a taxable 10-year AA muni, right, which is not that far below the new Treasury credit rating, right, sitting in the low 3s, all of a sudden the muni makes a lot of sense on a taxable basis. Even a tax-free is sitting at 2.5 to 2 3/4 in some cases. That's still better than the 204 Treasury with not a whole lot of extra risk on it. So we're seeing these non-traditional buyers. And meanwhile, retailers going, oh my God, munis, Puerto Rico, Detroit, Chicago, the world is ending. You got to know your credits, folks. And, I went to a brunch last week held by an investment company, and a lot of good professionals in attendance. But what I can tell by the conversations and the questions, the lack of information that exists out in the branches of all companies among among those tasked with investing people's money is a little concerning. These aren't unintelligent people. They're not being given, in many cases, the proper information and the proper explanations. And that we can go back to the lack of talent on various desks around the street. That was a concern a few weeks ago when they said the experience level on trading desks, for instance, is a lot lower than it was before the crisis. Well, these liaisons and support people and maybe even strategists in many cases don't have enough experience to walk some of these advisors through this. So what do the advisors do? We'll stick with an outside manager and we'll hope for the best. I don't blame them. They're not getting the support in many cases. I'm trying to give the support. But I've even had pushback with people saying $299 a year just to talk to you and read your stuff. Yeah, well, you get the right information. You can tell by my bald head and my gray hair. I've been doing this a long time. You can tell by my writing if you read it that I know what I'm talking about. So this is what's changed in the muni market. It's no longer the mom and pop market it was. Yes, it's still 70% retail according to Sean Carney, but it's not that dedicated retail buying insured bonds all the time type of market. So it's a more dynamic one. It's more credit market like, and I've mentioned that before. We had where was she here? Kathleen McNamara. Kathleen McNamara is from Wealth Management Research, and she discussed. The muni market, and it came to some similar conclusions. Oh, by the way, Sean Carney, great idea. I mentioned it before. I want to go back to it. He says investors must know what they own, and that's specifically in high yield munis, which are, by the way, 40% of that market is Puerto Rico tobacco settlement bonds, which are in no way, shape, and or form secure investments. They are junk. And they can run into funding problems down the road potentially. So they're not for everyone. But Kathleen McNamara, upon posed and then try to answer the question: are munis rich or cheap? And she said correctly, it depends on investment objectives. Whoa! So goals, objectives, risk tolerance, suitability matter. So it's not like munis are a buy, munis are a sell, munis are a hold. No, it depends on the client, the investor, and it depends on the muni in question. Interestingly, she has a similar outlook as Bond Squad. She sees subdued inflation, could see a flight to safety or quality. We also could see a new supply this year is outstripping 2014 levels. That could cause credit spreads to widen, yields to pop, and maybe present a buying opportunity for some municipal investors. She also sees a gradual modest rate hikes, a bear flattener. That's where short-term rates rise more than or exclusively versus long-term yields. A bear flattener, selling flattener, maybe sell bonds, yields rise. Right? She doesn't see long rates blowing up. And you know what? Nobody at this conference saw long-term rates blowing up. John Musso at Cumberland, one of our favorite outfits, said that they're focused on the U60 underemployment rate. It's a better indication of labor slack in their opinion. Mine too, And he said the Fed shouldn't be worried about the Fed shrinking its balance sheet because it appears that there's plenty of demand to absorb that, and we saw that with tapering. When the Fed tapered, there were fears that there wouldn't be enough buyers for long-term treasuries, and here we sit at a 204 yield in spite of central banks selling. Sean Carney back at BlackRock also mentioned that if you take out the years the baby boomers entered the economy as consumers and workers, that the 10-year treasury yield has averaged right around 3.10%, 310. So from the early 1900s to those times. I believe that's what he said, but I know it was 310. And so there's not much impetus for higher long-term rates. Okay, so if and not much impetus for higher inflation. So in my opinion, tips are a hedge, nothing more. And if you want to get some yield, you're probably okay as long as it's within your goals to extend a little bit out on the curve. And that was another common theme, that the sweet spot in the munis, if you can buy longer term items, is probably 10 to 20 years or somewhere in that range. There's not a whole lot of rate rise expectations on the long end of the curve at this point. One concern there was a lack of liquidity in the municipal bond market. There are far fewer market making dealers, or the dealers that can't make markets like they used to, and there's fear that if there is a sell-off, there's not enough buyers out there. And one participant, I'm not going to mention his name because this is a touchy subject, and I don't want to throw him under a bus, but he's concerned that because the lack of dealers, which has shrunk by a half to 2/3 of bidders, that some of the participants, the larger ones that can bid, are bidding down. They're bidding down the bunch, trying to squeeze out the smaller guys, making it difficult to get competitive bids. So if you look at the trade municipals, or you're in a portfolio where the manager has a trading strategy, the trading strategy is only as good if they're as good as the counterparty liquidity on the other side. If you're buying to hold, clip the coupons, get the principal back at maturity, you're probably not in bad shape here. In fact, you could take advantage potentially of some of the illiquidity and the blowing out spreads and the drop in prices to your advantage. But you can't look at it as if you would equities. Oh, they're down. Look at my statement. What am I going to do? That's not the way you approach. That's not the way you approach. Fixed income investing. Sean Carney also mentions that the use of fixed income or municipal bond separately managed accounts has gone up quite a bit. I believe it worked out to where they've almost tripled since the crisis. I believe that's a good thing because you want to own your exposure. You don't want to be subject to the actions of others. And then we had Puerto Rico, and that's a touchy subject. And Michael Combs at Cumberland was the one who discussed that, and he believes it's more of a liquidity problem in Puerto Rico at the present time. And by liquidity problem, let me get this. I don't want to misquote him here. Where did he go to here? No, I'm not going to show you the screen. That would be wrong. I want to get this up here. He believes that Puerto Rico has its biggest problem is liquidity. And bear with me 1 second. I apologize. This is a rebroadcast because of a microphone problem, so I do apologize for the choppiness here. He said it's really not a government. It's not a high government debt problem. He pointed out that that tax collection is a big cash economy is falling behind. That has a population problem, an exodus. That Puerto Rico does have ways to close the gap, as it were, but probably not completely close it. So he's still looking for haircuts on many Puerto Rico bonds. I think you'll probably see them on eventually on even the GO debt, but that remains to be seen. All right, but investors should not be in uninsured Puerto Rico bonds thinking that an outcome of par maturity is a given. Although Mr. Combs points out that the governor has now backtracked on the haircuts a bit, and he's emphasizing the importance of Puerto Rico making good on its debts, making bondholders whole. I don't know if they have the ability to do that. And Mr. Combs says that. He said, nevertheless, a restructuring of Puerto Rico's debt in the near future is quite likely. Ideally, a control board will be founded to handle the Commonwealth's debt and decisions about it. Perhaps the control board should also handle tax and spending measures, but it'd be harder to get the local governments to go along with that. Okay, so haircuts are probably coming. You're probably not going to get par. I feel bad for the investors who didn't realize they were exposed to Puerto Rico or exposed to Puerto Rico in a large way, but haircuts are probably coming. But by now, maybe you've taken the worst of the hit. If you still own them, they probably don't go to zero, right? So I wouldn't know if, I don't know if I'd buy more here, but if I had them, if you can take the volatility, maybe hang on to them here. That's a suitability question. That's all I have for today. I did want to touch on one thing. I did mention on the first broadcast, which had no sound. Back to the credit markets. I think there's a misunderstanding of how we in the fixed income market look at yields and credit spreads between treasuries and what the bond market tells us. The bond market is very useful. Like we've seen credit spreads blow out in the cash high yield bond market, right? But the bond market, the cash bond market, can sometimes not give an accurate picture of default probability sentiment or credit constraint sentiment, because it has more retail investors who might tell their advisors or their money managers to sell, maybe even when they shouldn't. It also has to build an interest rate component. Remember, corporate bonds, even high yield bonds, are subject to both credit quality forces and interest rate movements. So they'll build that in. But the credit default swap market is purely a credit measure. It's a credit market, in that if I want to insure a bond versus default, I can go to a counterparty and pay them 300 basis points on 5 million notional, and I can insure that bond against default. If it defaults, they give me par, and if I have the bonds, I give them the par. They give me that, and they'll get the difference. Working it out with the company and through the bankruptcy court. So I look at the credit default swap market and compare it to the bond market, and to see if the bond market's being, for lack of a better word, priced inefficiently. Okay, and it's usually the bond market, the cash bond market, that's priced inefficiently if it's out of line with the CDS market, because the credit default swap market is a pure credit story, and it's populated by institutions. When I was back at Citi, and I still think this is the case, 5 million was the minimum notional amount for a credit default swap, or the typical minimum notional amount for credit default swap. So mom and pop really can't get involved in that. So I decided to do a little research. First, I looked at a metals and mining bond. I'm not going to mention the name. If you want to know the name, call me directly. I'm not going to broadcast names for fear of recommending an idea, which I don't want to do here. But I looked at the metals and mining bond, and I saw that the bonds were trading for 5 years. I'm going to use 5 years. That's the benchmark CDS out there. It's also the typical maturity of a U.S. high yield corporate bond. So I compared this junk rated metals and mining bond to its 5-year CDS, and I found out that 5-year bonds were trading at 600 basis points thereabouts over the 5-year Treasury. I found that the credit default swap market was pricing credit default protection about 700 basis points notional, right? So I have to pay 7 points on 5 million, pay that income stream to insure my bonds. So that's telling me something. That's telling me that the bonds are probably still too rich, even at 600 basis points over the Treasury, right? So that probably has to widen out. So I went and then looked at an investment grade telephone company, and I looked at 5-year bonds versus 5-year CDS. I found 5-year bonds trading right around 130 basis points over the Treasury, over the 5-year. But I found credit default swaps around 50 basis points. Okay, that tells me, for whatever reason, liquidity reasons, panic reasons, just blowing out of fixed income in general, fear of rates, misunderstanding of these companies' exposure within its industry. But those bonds appear to be trading cheap versus credit prospects. So that's one way that a fixed income portfolio manager or strategist looks for relative value. Not the only way, but it's one of many factors that I consider. So I can tell, at least versus market sentiment, which is imperfect, are these bonds priced richly or cheaply versus credit sentiment? Then I can make my own analysis on interest rates and so on and so forth. But there's more to buying a bond than is it a premium or a discount? Did it sell off? Is the yield attractive? Yield attractive. Yeah, a 5-year bond with a yield around 6% might look really attractive until you find out the credit default swaps are trading at, for lack of a better term, 7%. And then it's like, whoa, these bonds are rich, and that means everything is relative. And with that, I'll leave you here. I'm sorry that this is a bit rushed and hastily given. Like I said, I had to redo this at the last minute, almost 2 hours after the fact, and I have a ton of work to do here because I'm in Philly tomorrow. So have a great night. Any questions, email me, thomas.byrne, B-Y-R-N-E, at WS Whiskey Sierra, the word and, amazonmike.com, or call me during market hours, 570-424-1555. And with that, have a very pleasant evening and good night.